welcome back. Today we're dealing with foundations of cycles. So this is new material for CMT1 this year in 2019, but really good stuff. I've known Kyle Crystal for many years and the work that he's done on cycles. So it's a great improvement over the previous work that was done. Because I think in the past, cycles has always been like a little paragraph within a much bigger chapter, but it's such an enormous topic. And so many people do it. You know, we have many clients all around the world who are using cycles as a huge part of their whole investment and advising business. So it's really nice to see that here. So a few things we're going to be talking about is obviously looking at the two types of cycles, etc. Identifying the three defining characteristics of a cycle, list the Hurst's 7 principles of commonality. Now, J.M. Hurst was a NASA aeronautical engineer in the 1960s. A group of traders actually asked him to come in and help them look for cycles and try to identify cycles in market data. And so obviously he had access to NASA resources, and so he was using those mainframe resources trying to find cycles. And then out of that he wrote 3 or 4 books and then created a chart service as well in the 70s and 80s. So very fascinating, but based all on science. You know, the work that he did, it's all really based on mathematical proving of cycles and using Fourier and things like that. So, you know, we'll talk more about that both in CMT1 but also in later levels as we get in a little more detail about how cycles work, etc. Defining a composite wave, identifying left and right translation, describe the dominant cycle, and then covering a couple of tools. So they're the learning objectives for this section, but let's jump in and have a look at the material. So obviously cycle characteristics, as I said, the study of cycles, it goes back a long way. I think it's a huge thing. And I think really the foundation of it's more of an economic thing. Why do we go through these periods of boom and bust, and you know, why do they not happen perfect regular intervals, but you know, we start to see a pattern there. Unfortunately, it feels that many times we see the pattern in hindsight where we're looking back. So it's trying to find those patterns in the past and then be able to project them into the future. The business cycle is obviously a macroeconomic cycle, and there's a lot of people studying that in detail. And again, of course, that's so that we can forecast when we would expect the next business downturn, etc. In TA, obviously, we don't just look at it from a macro perspective, but we get down to the individual securities, saying, okay, what cycles are driving this? You know, what cycles are driving the human behavior behind these stocks and the buying and selling? You know, and it's like that we often say, the actual big macro movements of the market, they're not really driven by technicals. They are driven by fundamental factors, but it's the technicals that help us identify and time and find opportunities within these movements of the securities. So, you know, with this and with cycles, it does give us an idea of when we can expect the next change in trend. You know, because again, like we said with Dow, we want to stay in the direction of the primary trend. So it gives us an inkling that, hang on, we're now getting a very clear cycle. We've hit another low. We're expecting the trend to change. So we definitely want to trade with that. Cycle is a repeating pattern of rises and falls in a security. So two types of cycles as per the learning objectives there. We have fixed cycles where each interval is fixed-ish. You know, I think it's very important with cycles, if you're looking for a perfect cycle, that the low always falls on the exact interval, you're going to be very disappointed. There's always a variance that happens. Nevertheless, within an area of tolerance, they are fixed intervals that we're looking at. And we call them linear cycles. The other one is cycles with an expansion or a sequence. So you could take Fibonacci number series, and as that expands, the Fibonacci number series, 1, 2, 3, 5, 8, 13, 21, where we're adding the previous two to get the next value in the sequence. That's obviously going to expand, and you can see an example of that here on this chart. This is using one by Chris Carolyn called the spiral calendar, where we base it off this start point and then it expands. I'm not showing the first, I think, 20 odd lines because it's too small, but from this point on you can see the expansion happening on this one. And so that's more of, rather than measuring a cycle, it's taking a discrete event and then putting an expansion off that. So we call that a non-linear. So I think you've got fixed cycles as linear, sequences which are non-linear cycles. They're the two big types of cycles that you need to know. For the most part in CMT1, we're just staying focused on fixed cycles, although we will touch back on some non-linear examples in another session. So the cycle components, there's three things that you have to know about cycles. You're going to have to know the amplitude. So the amplitude is the height of the cycle. Remember that, let me just jump forward. I want to go forward a slide. When we're dealing with cycles, and if you've never really studied this, or you've never done physics at a university level, etc., this can sometimes be a little bit confusing. So if we're starting here at 0 and then we go around and around, because whenever we deal with cycles, we're talking so often about degrees around a circle, and we're considering it to be circular in behavior. The point is that as we go from starting here and move through time to get up to 90 degrees, if we consider this to be like a price chart and we were moving through time, at any point in time, we are going to be at a certain place around the circle. So that's how we end up getting our sine wave. It's really a function of saying, let's take our rotation around the circle and project that in time. Hang on, from you it's probably this way. I've got to reverse my thinking. And let's project that in time as we move. And then we get the wave that you see and what we identify in charts. So when we see that sine wave pattern in a chart, we're immediately thinking, cycle. And so there's a lot of elements that come back to that. So amplitude is how high it is from the baseline here. And so you've got that. You need to know about amplitude. You need to know about wavelength here. Or period. Now, wavelength period, we'll talk more about that later. Wavelength is saying what's the distance from one peak to the other. But in our world, we measure distance like that on a chart in time. So, and the period is how long does it take to get from one end to the other. And so it's pretty much the same thing for us. In physics, if we're dealing with light and things like that, wavelength and period are different. One's in meters, obviously the period is in seconds or microseconds, depending on what it is we're dealing with. But just be aware of that. For the most part, we talk about period when we're considering the length. Now, the wavelength is just saying from one point in the wave, how long does it take, or the period I should say, how long does it take before we get back to that exact same point? Typically in finance, we measure from trough to trough. So cycle low to cycle low is where we do our measuring from because it's easier to identify. And we'll deal with a lot of examples as we go through these two sessions, and you'll see that. So we've got the amplitude, we've got the period there, the troughs and the peaks. You need to know. The final component that you need to know is phase. That's the third component out of the three that you need to memorize. And so phase is all about a translation that happens in the wave. See, if we started this black wave here, we would say that that is completely, it has a phase angle of 0 and is completely in phase, if you like. This red one, you can see that at the starting point here, we're down at negative 90 degrees. So we would say that it's 90 degrees out of phase, and it has a phase angle of 90. You can actually just say, right, let me just measure this. And you can see that at this point of 90 is where this is at 0. So again, it's 90 degrees out of phase. But phase is all about that translation on the time axis. I really don't think you're going to have to do massive phase calculations or anything like that. So the point really is just to know that what are the three, I can kind of see a multiple choice question where they're saying, what are the three components of a typical cycle? Amplitude, period, or wavelength, it could be either one of those, and phase. They're the three things that you've got to remember for that. Phase angle, so if I even looked at the black plot here, at this point here, I would say that my phase angle is 90 degrees because I'm 90 degrees through my cycle. So again, just keep that in mind and you'll be fine. Frequency. Now, frequency is directly related to the period. So as I said, wavelength is the distance between those 2 points, but the period is the time it takes to get to those 2 points, from one point to the other way around. So the frequency is really saying, okay, if this is how long it takes, how many waves are going, or how many cycles are going to happen in a fixed amount of time. And the way we work that out is we just take the period from one point to the other, and we take the inverse, so 1 over whatever that number is. And that's how we get that. So an example here, if it takes 40 days to complete one cycle, or one cycle, what is the frequency? Well, all we do is 1 over 40. So that means that it's 0.025 cycles per day. And another easy way to work, if it took 4 days to complete a cycle, well, what's the frequency? Well, it's a quarter cycle per day that's happening, so 0.25. You can see how the math works there. I think it's important to remember this inverse that you'll have to know for the exam. I can imagine that you're given a period. They say a cycle's been observed and has a period of 100 days to the cycle. What is the frequency? And so you'd have to say 0.01 or 1 over 100. That would be something I can expect that you would need to know. So the frequency is the inverse of the product, period, I should say, making sure I get all my notes here. It's a number of cycles that occur in a unit of time. All right, so J.M. Hurst, this is what I was saying about him before. He is considered to be the father of modern cycle theory, and he released his first books in 1970. A couple of his books there that you can still get, and again, if you do get them, great to add to your library. They're all actually really interesting books, having gone through them. I do believe that wherever possible, try and get the original versions of these books. Of course, you don't need them for the exam, but if you are interested in cycles, this is a really good set of books to get. Passed away in 2005. So there were 7 principles, when he looked at his work in cycles, he said that there are 7 principles of commonality, things that are common about cycles and what you expect. And if these weren't true, then the premise behind much of his work wouldn't hold up. And so this is what he was working at. So price waves are made up of a series of complex interrelationships. We see that. It's not just a nice smooth run up and then a smooth run down. We get these secondary waves and tertiary waves and tertiary trends like we studied with Dow. The concepts described by these principles allow for a technical approach, and I think that's what's really nice about this, because when most people approach cycles, they approach it from a very objective method, whereas Hurst was coming to it trying to be very scientific and use mathematics to be able to identify and then project based on cycle work. The great thing, and again, this is the fractal nature of so many things that we work with, it's just as applicable to long-term time frames as it is to short time frames. So it can be used in a very similar way. So now the principles. So all of these bolded titles are things that you do need to remember. I would suggest writing these out. Again, like I talk about a lot, you can print out our notes, but I do suggest this is something you want to write out and remember. It's one of the learning objectives, so very important. Cyclicality. All financial markets are composed of cycles no matter what the security. And many cycles being added together is the other point there. So that's one of the principles. The other principle is harmonicity, or some of these names are just crazy. Just remember how to write them down because they're made up words, I'm sure of it. Anyway, a cycle's harmonics are related by multiples of 2 and 3. So if we have a major cycle like this, there's going to be subcycles, but what we find is the subcycles will always come through and end on the same points. Now, typically this image is probably a bad image because, again, when it comes to what we do in finance, it's actually the lows which are lining up, and that's one of his principles as well. Nevertheless, we have the dominant cycle, and within that dominant cycle are harmonics. We take that length, we divide it by 2, we divide by 3, we divide by 5 or 4, and we get these sub-cycles that all fall within the same pattern. And so, they're very important because they also confirm the validity of the dominant cycle. So when we see the presence of these sub-cycles, that lets us know that the dominant cycle was the correct choice that we started with. Summation. So when we have these sub-cycles, they get added together. So, and that's what creates the very distorted look that we see in many of our price charts. So if we take this green wave here is our fundamental cycle, and then we have this olive version, well, when we sum them together, then what we end up is this, where we get suddenly a maximum where they both are high at their peaks. And then because this falls away quickly, we get this rapid deceleration, and then you can see the opposite happening here. Now, when we do this Fourier work in Optuma, what we get is we can start with a 370 period wave, which is just this even sine wave. And then we get 183 one, and then we get 106. But when we sum them all together, this is what it ends up looking like. And so it becomes very interesting. The theory behind Fourier and Fourier work, we did a lot of this in engineering when I did communications engineering, is to say that any complex wave that we see can be divided up into subparts, into sub-sine waves. And so the more of these harmonics and components that we add together, the closer we get to replicating what we see in real life. Now, that's from a signal processing point of view. We apply the same work here in the Fourier work on price charts. And this is only 3 components. And you can see the difference that 3 components makes on this wave already. And we can keep adding more and more components. As always, the more we fine-tune that, the less likely it is to be significant as it goes forward, unfortunately. We sort of find that around about 5 components is usually about the best there. But summation, the price is a composite wave of the sum of the individual cycles. Synchronicity. Cycle lows tend to all bottom together, and that's something that we use whenever we do cycle research. We're looking for these lows all to be together. An even harmonic will always bottom with its next large period cycle. An odd harmonic may be off for a couple ones in the middle, but then gets back in sync again. So if we had 2 here, and then we had a 3 period harmonic or a multiple of 3 in there, it may be off for one of them, but then comes back again on every second one. The magnitude or degree of the low is related to how many cycles are bottoming. If we've got 4 or 5 cycles all coming together, which is pretty much what happened in 2009, then we're going to see this massive low coming in, and then things spread out again. So synchronicity is the lows all coming together. Proportionality. The amplitude of the cycle is proportionate to how long it is. Long-term cycles have massive amplitude. And that's why you get this situation where you've got the market moving up. Short-term cycles are being carried along by the long-term cycle, as well. So longer cycles create the trend for shorter cycles to ride. It fits with the fractal nature of technical analysis. So proportionality is saying that the amplitude is proportional to the length of the cycle. Nominality, another one of these words there. Some wave periods are more common than others. Now, a lot of this can be due to a number of factors, whether it be seasons, whether it be other influences, whether it be the presidential cycle, things like that. We do start to see that there are these nominal cycles, which, while they may not be perfect on their own, they're a great starting point for cycle research. We talk about the presidential cycle, we talk about the business cycle, we talk about the decennial cycle. That may not be a perfect fit for a given security, but it is always a good starting point to look at this. Now, Hurst himself, when he would do his work, he actually came up with his own nominal model, and that's where he had 18 years. I find that interesting because the real estate cycle is 18 and a half years. So interesting that he started there. 9 years about the business cycle length, 4.5 close to the presidential cycle. So these were periods that he would start looking at and see whether it was a good fit or not. And then down into months and then down into weeks as well. So again, the nominal cycle, it's not saying that a security has to follow these periods, but it's the starting point of any cycle-based research, which again, Hurst was using. So the nominality there. Variation, financial markets will not obey theoretical perfection. I think I've said that now enough times. It would be nice if they did, but that doesn't mean that this work, etc., isn't something that should be pursued, because these cycles, they really are an important part of research when it comes to technical analysis in this area. But we do expect there to be variation, particularly in translation. Is it right translation? Is it left translated? So that's really the cycle lows and highs. We may expect a high or a low to come in on a given day, but it comes in a little bit early. In that case, we call that to be left translated if it comes in early. I've got to reverse everything for the camera, so that's why I'm hesitating here. If it comes in late, then we call that right translated when it comes in late there as well. So we expect there to be a translation in the lows. That's just what happens. Harmonics may not be a perfect harmonic. Sometimes harmonics are strong and then they fade out. Often I actually feel that that's probably more the point that harmonics are being affected and pushed around by other cycles that we haven't even considered yet. But nevertheless, harmonics, we do expect variation there. Proportionality. Remember we said that the length of a wave should be proportional to its amplitude. Sometimes there's variation there as well. It's not a perfect relationship that we're looking at. As I said, harmonics can disappear and reappear over time. A cycle's amplitude may be disproportionate to its period. So they're, the things. And so, the first 6 principles of commonality are describing all of these things, and then principle number 7 is sort of undermining a little bit of that. But that's the world we live in. The dominant cycle. So the dominant cycle is the one that's the most visually evident on the chart. It's when you look at a chart and you see low happening. When you look at some of the commodities like lumber, corn, wheat, soybeans, etc., you start to see a really obvious yearly pattern, a yearly cycle that's going on. And that's to do with the growing season and things like that. But that's definitely a dominant cycle that you'll see. Typically, we observe this on the chart. You know, we look at the chart and we see what the dominant cycle is and we base everything off that. We're looking for that obvious sine wave that's happening. Once a dominant cycle's been identified, then we can use other tools to confirm it, like a spectrogram. We'll talk about that in a moment. The dominant cycle becomes the pulse through which all other harmonics and price and everything interact and can be viewed and do analysis of as well. So looking at this chart here of lumber, you can see that I've basically worked on saying, let's take this low here, my first major low, and then I look at the next low here. Now I've dropped this a little bit short of the low. I actually feel that there's a little bit of right translation on this first cycle because I'm looking at all the subsequent lows. And I want to make sure that I'm getting points in the future which are significant. Obviously here, lumber went under a massive boom. In 2012, the economy was starting to kickstart. The building industry was kickstarting again in the US. So the demand for lumber was high. We didn't see the big low come in. And this is that whole thing of, yes, we have a dominant cycle, but that dominant cycle is part of a much bigger cycle, which was obviously pushing prices up. Nevertheless, you can see some significant lows which are falling on that seasonal cycle that we picked up there. All right, spectrograms. So this is now using Fourier work. Now again, a great book on this. This is actually the book that I used when I programmed all of these tools, Fourier-based tools into Optuma. This was actually written in the 1920s. Henry Ludwell Moore, he was doing research into rainfall patterns and he was using Fourier to enable him to search for cycles and patterns so that he could start doing some forecasting on rainfall in the Midwest. Great little book, it's not a hard read, and he explains the math better than I'd ever read anywhere else. So it's definitely a good one to use there. So, but the Fourier transforms we can use, and they enable us to create these displays. Now, what's really important here is that this indicator down the bottom, which is our periodogram, spectrogram, periodogram, that's what J.M. Hurst called them, and so that's what we labeled them when we did this work. But essentially it's saying, let me look at all the cycle lengths. Now, if I move this chart back and forth in the software, I compress it, this view down here doesn't change. It's just completely by coincidence that this peak is under this high. This isn't a typical plot. What we're showing here is a cycle length of 1. So let's say 1 day. Is a 1 day cycle significant? No, it's not, because I don't have a peak on this indicator. All the way out to 500. So if I went back and compared today to 500 days ago, is there a cycle there that's significant? No, there's not, because again, I don't have a peak. Where I do have some significant ones is 429, it looks like. A bit hard to read on that monitor there. 365 yearly, very significant. 309 is another significant cycle. So I've got 3 significant cycles there. But again, what I'm always looking for with these is harmonics. So if I'm looking at the 429 there, I can see that I've also got another peak at the half, or 1/2 obviously, the half harmonic. So that would be something that, were I doing this work, I would definitely be looking at those periods as well. And that's how we look at this. That's how we get our dominant cycle, is by using these spectrograms to be able to do that. So again, taking that same security, if I were to add these first number of securities, it must be 419 that I'm on there. So I get 419, 365, 219, which was the half here. So I wanted to get this 365 because it was a dominant one. I could have added 309 as well, but I wanted the harmonic. the 219 there, I get this wave built by Fourier. So where in the spectrogram, we unpack the cycles using Fourier. Then what I can do, once I've identified the major coefficients, I can put that back together again. And so that's what we've done there with Fourier. And we see again, these turning points are significant points in this market. You know, this low is matching up this high, a little bit of translation there. This turning point here, again, is significant. While the exact shape may not be right, it's the general idea of what's happening, which is very interesting to this work. So again, we just add those cycles back in as we go. All right, so wavelet diagrams was another part in there. Unfortunately not in Optuma yet, something that we've been wanting to do. So this is really nice because what it shows is if we have a cycle length here, so we've got 15 days, 100 days, 200 days, etc. Whenever it's bright is when that cycle length is really clear. You know, it'd be like on here having a really clear peak. But that peak that we're seeing right now, that's as of this point. You know, when we go back through the history of that chart from today going backwards, we've got a dominant cycle. But if I did this same analysis in a year's time, that cycle may start to fade and not quite be as strong. So what the wavelet diagram is it allows us to put in a time factor where in 2007, I can look back in time, what was the dominant cycles? Get to 2008, you know, and do that for every day, and I get this diagram here. So we can see that, let's say it's about 150, I think, on this chart. I can see that, oh wow, it was a really strong dominant cycle for a couple of years there, and then starts to fade out again. So very important again, shows really that fading in and out that cycles can have at different points in time as well. The Fisher transform. So this is something that has been created. It's a method of working with these. Now, I'm not sure if you've done the statistics modules yet. I know that's a little bit further down in our course, but when you get to the statistics, we talk a lot about normal distributions and things like that. The point with a normal distribution is that we expect there to be a maximum in the middle of the observations, and at the tails, we don't expect to see as much. Now you can see that here. So if we have a normal distribution, we have this maximum, and then we have minimums at the tails. The problem with a sine wave, if we look at a sine wave, is that, you know, the value, the data series, whatever we're looking at, it races through this point in the middle, and then spends a lot of time as it slows down and then speeds up again at these maximum. And so this is what we get for a probability distribution function, which is what the normal Gaussian one is. If we were to do that on a sine wave, saying how much time does this sine wave spend at the extremes or at different values between, you know, a high and a low here? Well, what we would end up with is this type of plot. So at around 0 degrees, which would be the middle of our plot here, it spends very little time because it's racing through that value. But at the extremes, well, it spends a lot of time. And so the Fisher transform is all about saying, let's convert that. I think we're using natural logarithms to convert this U shape into a normal distribution, because then we can do some statistical work on that. We know I'm just got to make sure I get all my notes. We know the prices are not normally distributed. They behave more like a sine wave where they spend more time at extremes than at the center. If a channel is formed around price, then we can see that same distribution. So the Fisher transform takes a distribution, changes it into one that is approximately Gaussian by using natural logarithms of the values. Peaks and troughs you'll see in this indicator. So if you look at the Fisher transform indicator here, like many indicators, you're going to see this again and again. We typically have a calculation that we do, and then we put on a small moving average, 3 period, something like that, which then creates a signal line. And so we've got this fast line with a slower moving average coming up behind it, and it's not until this fast line crosses the moving average or the signal line that we take some action. Nevertheless, you can look here at some of these peaks and troughs, and you can see through the chart here that there's a pretty good correlation between that. Again, we set some links on Fisher and things like that. I think what's important to know, particularly for this exam, is how the Fisher transform uses natural logarithms to identify cycles and to convert cycle data into a probability distribution, and then how those tools work there as well. All right, so that's it for the foundations of cycle theory. The 2 types of cycles, fixed and the sequences, or the linear and the non-linear cycles. Make sure you know that. The 3 defining characteristics: amplitude, wavelength or period, and phase. They're the ones that you have to know. Listing those 7 Hurst's 7 principles of commonality. Make sure you write those out. You want to know them, what they are and what they mean. Defining the composite wave, which is the summing up. So essentially, the composite wave, this learning objective, is one of Hurst's 7 principles of commonality, and that's the summation commonality principle there. Identifying the right translation when a cycle low comes in late, or the left translation when it comes in early. Being able to describe a dominant cycle, the one that you can see that's most obvious on the chart there, and then how harmonics reinforce the dominant cycle. And then the different tools, the spectrogram, the wavelet diagram, the Fisher transform. I think a question you can expect is something along the lines on what is a tool that can be used to help with identifying cycles. And maybe you'll get one of these tools added, or maybe it's all 3 tools and the answer is all of the above. Or pick which of these tools is not used to help with identifying cycles, and maybe an RSI or something like that is in the list. So you can expect things along those sorts of lines as well. All right, so we'll continue on in the next session. Thank you.